What a time to be an investor. At the start of this year, I started with £14,103. Now, 2024 is my first year being invested into the markets, and I definitely learned a lot throughout this positive period. I made some great decisions as well. I like to describe this period as me planting seeds, and now I'm starting to see those seeds sprout a little bit, which is obviously great, and to see that hard work pay off. Now, fast forward, if you would have said to me and sat me down and said, Kai, your investments would practically double, you'd be sitting at around 34k invested into the markets with added consistent contributions and gains on top of that, I'd have probably laughed in your face and said that you're lying. Now, interestingly, coming into January, there was still a handful of investment firms that still had a bearish outlook onto the markets coming into 2025. Now, this was mainly fueled by a slowing US economy and extreme valuations. Now, while some of that information still holds true, we are still making all-time highs, and institutional investors are still buying the dip, which is a fantastic sign. Now, this motivation is continuing. In my opinion, it doesn't seem to slow down, which can say a lot about if you was to forecast yourself and just say sitting on the sidelines waiting for the perfect time or a crash, you would have missed out on amazing gains and opportunities that have clearly risen within this year so far. Now, I know a lot of you guys have been asking for me when the next portfolio breakdown will come, so here we go, guys. We're going to be showing you guys what I have added to the portfolio, what we'll be doing moving forward, as well as my current outlook on the specific positions that I'm still entered within. Now, so far as of recording this video, the S&P 500 is up just over 12.2%, and we recently just broke all-time highs, which is a fantastic sign. Now, we've also had some fantastic deals, particularly between the UK and US, with Trump's most recent visit seemingly being quite positive for the UK in general. Large asset managers like BlackRock have pledged to invest just over $700 million into data centers across the UK. Now, obviously, with the general tech sector as well as the semiconductor sector, this is clearly growing within demand, and large investors are obviously seeing opportunities within countries like the UK. Now, this can obviously be positive for domestic companies as well, and the large public companies like the Nvidias, the AMDs, all of those types of companies, because it shows that there's still appetite and growth within these sectors currently. Now, with these gains and all-time highs being smashed, there are three main key drivers that are fueling this rally to the upside at the moment. Now, the first driver is the market driver, essentially, and this is mainly due to the fact of we're having very, very strong earnings, and this continued rally is obviously being supported by AI, the semiconductor industry, as well as an appetite for different industries across the tech sector, which is great. Now, with these expectations and earnings continuously growing, the Fed are also fueling this by potentially cutting their interest rates in September, which is very, very likely at the moment, which is positive for small caps because it makes their cost of borrowing essentially much cheaper. So we're even seeing gains in small caps as well as the S&P as well. Now, what really stood out to me was the Trump-China tariff situation, essentially, as he was imposing insanely unsustainable tariffs on China, getting up to rates of around 145%, which, as we know, wasn't sustainable, especially for the long term, because it almost seemed like the US was cannibalizing themselves just by Trump doing that. Although he had imposed this, he keeps extending the 90-day period, so he's just extended this 90-day period again. So obviously it's very unlikely that Trump would impose a crazy amount of tariffs onto China. If I was to guess, it'd probably be something a lot more sustainable, something that will make a lot more sense, in my opinion. But the overall markets haven't really reacted negatively to this. As we can see, looking at the markets, we're still hitting all-time highs. So maybe these institutions know that, you know, for the long term, the US can't really sustain those tariffs from what Trump is doing at the moment. As we can see on screen, we can see the full transparency of my stocks and shares ISA portfolio as we sit at just over £35,000, which is a huge milestone so far for me. And we have seen some tremendous gains throughout the past 3 months, if I'm honest, and we're seeing some stocks that are starting to rally up to the upside now. So it's clear that the S&P 500 is my most dominant position so far, and it will likely remain my most dominant position for the foreseeable future, mainly because of the diversification that this ETF brings, as well as the low costs and overall maintenance that comes with it, as I don't have to rebalance this ETF at all. Now for me, having this solid S&P foundation is key, because I have invested into individual stocks as well, so that will obviously come with their own risks and subjectivities as we progress through the year. So having that base, that core ETF there, is kind of like the anchor within my portfolio, keeping everything almost glued together. And we have seen some amazing gains so far, with the markets making all-time highs. The other two ETFs that I hold the Vanguard All World, which is mostly weighted still within the S&P 500, but there will be assets that have been invested in throughout European companies and obviously throughout Asian/Middle Eastern companies as well. So it's covering the whole world from that perspective, but it's still very much weighted to the S&P 500 anyways, around 60% I think it sits at to this day. And we also have the emerging markets ETFs, which kind of just does what it says on the tin. It invests into emerging markets, emerging economies, which are promising, if I'm honest. And I think it's important to have this diversification, especially within the emerging spaces, because a lot of these companies, if you're looking 10 to 15 years down the line, they will be doing considerably well, considering the amount of capital that's being pumped within them. We likely will see gains throughout that perspective. Now onto the stock side of things, we're going to start off with Alibaba. And again, if you've been following my updates for a while, you'll know that this is my riskier position of the portfolio. But because I've been scaling into this position since probably around June last year, and again, I'm fully invested at the moment, and that's mainly because the reason why I got into this position is because of how undervalued it was from especially like a PE perspective, so price to earnings, and the amount of cash that this company was sitting on. The company was doing share buyback, so buying back their shares within the company, which is a positive sign. I prefer that over companies issuing dividends, because it shows that the company is confident in terms of what they're offering. They're buying back their own stock. So a lot of this growth at the moment has been fueled by their cloud and AI offering, so to speak. So Alibaba is doing fantastic at the moment, and I still think that this stock has a long way to go. Now I can see the stock hitting $200 or even the all-time highs from the back end of COVID, where we had that period to the downside. So yeah, this is definitely a great position for me. I'm not going to be selling anything at the moment. It's definitely a position that I will sell longer term, but there's still so much room for movement, and again, it's doing so well. Now following on, we have Amazon, which I bought in two tranches, so to speak, back when we had that pullback in April due to the Trump tariffs, right? And again, saw a fantastic opportunity obviously to get myself involved in Amazon. Amazon is one of those companies for me that is very much a buy and hold, mainly because of their offering. They're dominating the cloud space, although there's players like Google who are still going to eat up market share. But think of Amazon, we use their products, not their products, but we use their services all the time. They advertise a lot, and they're making a lot of capital and cash flows through their businesses. So if you was to say to me, would Amazon be replaced in 10 to 15 years time, in my eyes, who will replace Amazon? Are people going to stop buying stuff online? Are we going to move away from the cloud for whatever reason? Probably not. These are some of the things that you got to ask yourself, and for me to get in at that price, it's definitely one that I'll hold on to, as I don't really have a reason to sell it. Now finally we have Google. So Google on my trading 2-on-2 account is definitely a much smaller position, but on my free trade I'm up over 120%. And again, this was a company that back then wasn't doing very well, but still was sitting on a ton of cash, and it's one that I got involved in and have decided to hold. And as we're seeing now with AI being more prominent, that's why we're seeing the rallies so far in Google. And we had some fantastic news that Google didn't even have to sell Chrome, but they will have to be a little bit more transparent with a one-time offering for essentially not monopolizing the data that Google hold, to allow a much more fairer playing site for other companies. So that was the main story that is propping Google up at the moment. It's mainly they can keep their Chrome side of the business, which is obviously great because the advertising revenues generate billions for the company. And lastly, you have Microsoft. And if you've been following my channel for a while, you know that I've spoken a lot about Microsoft, and for good reason. It's a very consistent company, and I got in with it at a great price, and nothing crazy has really changed so far with this company. It's been fairly consistent. There's not really been any crazy news that's been released, but there's not really much to discuss other than I'll be holding this position out until the foreseeable. Now with that being said, we're obviously going to be doing some live investing as we stay consistent throughout this, through the months, okay? And we're going to be investing in our classic ETFs again. You know, the reasons why is because right now I don't really see any opportunities to buy more stocks, and it's almost good to be a little bit cautious, especially when we're doing so well at the moment. It's easy to just buy different stocks for whatever reason, but keeping the base, the foundations there within the ETFs is really going to be the rock for my portfolio to lean on, essentially. So that's it for today's video, guys. If you did enjoy, or you have any suggestions in the comments below, or if you've created your own portfolio and you would like some ideas, obviously not financial advice, but it's always good to throw ideas out there and discuss. So let me know in those comment sections below what other content you would like.